Hi everyone. So welcome to the live stream today. Very much excited for having you on the live stream as we continue with our discussion for the ICA April 2022 examination. I see some of you guys joining. We are live on Facebook, we are live on YouTube, and we are also live on Facebook in our official Facebook business page. We are also live on that. So welcome to the stream today as we continue. Today we want to look at two key accounting standards that are critical, that are fundamental, that are basic when it comes to dealing with financial reporting and corporate reporting, and that is going to be IAS 2, accounting for inventories, and then IFRS 5, and that is going to be non-current asset held for sale and discontinued operation. So I see some of you guys joining. You are welcome. Comment in the chat box any questions you have for me, something you would want me to share my thought on. Let me know about it so that I will provide you with some recommendations and advice relating to that. So welcome. Give us a thumbs up on the video. Let's get some engagements coming in. Also share the video. Let us reach as many students as possible. Let me know. It appears my feed back or my feed pauses a little. Let me know if my sound also pauses like the way the video is pausing a little. Please help me to confirm that. I don't know. This afternoon it's like MTN doesn't want me to do the live stream, so it's like my network is jumping up. But I'm hoping that I'll be able to go through definitely. Right, so I see some chats coming in. Let's see. Amadu Abdul Munin said, "Good afternoon. I hope your family is fine." Yes, thank you for asking, Amadu Abdul. Thanks for joining us. Share the video. Let us reach many students joining us on the stream, and also give us a thumbs up on the video. It helps us a lot. Eric, Ahia Deki, and then Kwesi Ochri on Facebook. Thank you guys for the thumbs up on the video. Really appreciate it. Peter Chanda say hi, say always a pleasure to be here. Awesome, welcome, Peter. Chinenye Miriam. Forgive me if I don't mention your name right. Okay, so Chinenye Miriam said, "Hi, I am Miriam from Nigeria. Welcome. Give us a thumbs up on the video. Consider to also share the video. Let us reach many students coming and joining the stream." Kofi Pa Enterprise said, "The sound is okay. Thank you very much." Amadou Abdul said, "The sound is good. Okay." Tracy said, the sound is okay. It's just the video that keeps pausing. All right, thank you. I don't know. MTN is just messing me up this afternoon. MTN Ghana Limited, MTN Ghana PLC. You are a listed company. Please fix your network a little bit so that I can have smooth live stream. Okay, so Kwesi Ochri said the sound is perfect, but the video stops. Okay, don't worry. When I start sharing my screen, I think you will get it. Just that my video will be pausing like that. Sorry about that. The network is just not good. Paul Esiedu said the sound is very okay. Thank you, Paul. Welcome to the stream. Eric Ahiadeke said the sound is not pausing, but the video. Okay, that's fine. We will manage it like that. I'm going to share my screen, then we get excited about that. Ogundari said, "I am here from Niger." Welcome, Ogundari, for joining us on the live stream. Now, I see some of you guys joining. We are going to go into IAS 2, inventories, and IFRS 5, non-current asset held for sale and discontinued operation. Now, the reason why I'm starting with these standards is because these standards are the basic standards that sets the tones for us so that we can go into the bigger guys in relation to what we dealt with yesterday. Now, in case yesterday you missed the lecture, you can check the description of this video where I explain the way the standards are connected to each other and the way you learn the standards so that you can increase your chances of passing the examination. So consider to check out that video if yesterday you were not on the stream so that you can really get value for what we are doing. Your boy Eric said, "Hello, Nhyira. I believe I am not late." No, your boy, we are just about to get into it. Esiedu Paul said, "It's only the video that keeps pausing." Yeah. I'm hoping that will be better because I don't know, MTN. Just when I wanted to do my live stream, MTN decides to make the network slow for some reason. I don't know. But let's go. Once I start sharing my screen, It will be okay. It'll be okay. Now, remember to download our mobile application in case you've not downloaded it on the App Store or the Google Play Store. The name of the application is Nhyira Premium. You get access to the free lecture videos. You get access to some notes, blog posts on various subject, various topics. Some of you that want to really know me on a personal level, I share some personal stuff also in the application. So you want to check it out. Then also you can use the application to enroll in our courses to study and directly under my mentorship for the ICA examination. So consider downloading the app because whatever device you are on, we're gonna get you there. So let's begin the journey straight up. Let's go into IAS2, accounting for inventories, and let's just get excited about it. So when I start sharing my screen, I'm going to believe that the feed is going to be smooth, and then we were going to be going. So IAS2 accounting for inventories, IAS2 accounting for inventories, or just inventories, just inventories. Now, like I mentioned, even though the standard is a little bit broad, it has a lot of issues that we need to understand. There are key things that we need to pay attention to understand it. One thing you must understand here is that IAS2 also has some connection with other standards. In other words, the principles that we are going to be establishing in IAS2 inventories will be applicable in other standards. And I'm going to be illustrating that to you as we proceed with this series in the live stream. So give me a moment. Let me just bring this up here. So section 2. I want to make sure that I get my slide up. Thought I had done that. Okay, so we go. So I wanted to say last week. Yesterday we mentioned the connection that relates with the standards, and one of the things I mentioned was that the principle in IAS2 accounting for inventory, it's applicable in IFRS 5, non-current asset held for sale and discontinued operation. So, like I mentioned last week, you don't learn the standards. You don't learn the standards in isolation. In other words, they are connected with each other. So learning them in conjunction with each other like that helps you position you in order for you to really understand what you are learning, and most importantly, be able to pass the examination generally at the end of the day. So let's look at IAS2, then we'll go into IAS 5. Now, primarily, this is the takeaway about IAS2. This is the takeaway. The takeaway under IAS2 simply is that inventories are carried at lower of cost and net realizable value. I mean, that is the take home principle that I want you to understand, that inventory is carried at lower of cost and then net realizable value. Now, when we say net realizable value, what do we mean? So before I even get into the standard, let's look at some of the basis of measurement of assets in the financial statement. Let's look at the basis of measurement of assets or transactions in the financial statement. So basis of measurement. Now, if you did conceptual framework and regulatory framework, this is one of the key issues that we need to understand. Now, when we say measurement, measurement simply refers to the determination of the monetary amount on an asset or on an item in the financial statement. So the value we put on something is what we refer to as the measurement of the thing, or the measurement of that thing. Now, when we say recognition, recognition, on the other hand, simply refers to incorporating an item in the financial statement. So when we incorporate an item into the financial statement, it means that we are what? Recognizing the item in the financial statement. Now, there are various bases of measurement that we need to be aware of because they are going to be applicable in almost all the standards as you proceed. So it is critical for you to understand the fundamental basis of measurement. They include the following. We have the historical cost. We have the current cost. We have the net realizable value. We have the fair value. And we have the value in use. We have the value in use. So these are the basic basis of measurement that you need to understand before even we get into looking at the standards. I see some of you guys joining. You are welcome. We are looking at IAS 2 and IFRS 5 here. So give us a thumbs up on the video when you join, and also consider sharing the video. Let us reach many students watching the live stream and being part of the live stream, so together we can assist a lot of students. So when we say historical cost, what is historical cost? In a simple language, we say that historical cost of an asset is simply the cost incurred to acquire the asset. So when we are referring to the historical cost of an asset, we mean the cost incurred to acquire the asset. Okay, so the cost we incur to acquire the asset is the historical cost of the asset. Then when we say the historical cost of a liability, we simply means that the amount of consideration that is supposed to be transferred in exchange for the benefit received. The amount of consideration expected to be transferred in exchange for the consideration received. In other words, what we are trying to say here is that the historical cost is simply the amount that we incur initially in order for us to bring the asset to its present use. Okay, in order to bring the asset to its present use. And we're going to be expanding on this much later on. Then the current cost simply means that how much cost we will incur in today's term on that same asset. Okay, how much cost we will incur in today's term for that same asset. So let's say we bought an asset 2 years ago. If we bought an asset 2 years ago, okay, if we bought an asset 2 years ago, the money we paid 2 years ago to acquire the asset is what we call the HC, the historical cost. But then if we want to buy that asset today, that is January 19th of January 2022, how much will that asset cost us? The amount that the asset will cost us in today's term is what we refer to as what? The current cost. The current cost. But then when it comes to the current cost, there are two things that we need to understand about the current cost. We have what we call the reproduction cost and the replacement cost. The reproduction cost and the replacement cost. The reproduction cost and the replacement cost. Now, the reproduction cost relates to assets that can be manufactured or constructed by the entity. So how much cost that an entity will incur in today's term to manufacture an asset or to construct an asset is what we refer to as what? The reproduction cost. Whilst the replacement cost usually refers to assets that the entity acquires. Okay, assets that the entity acquires rather than manufacturing it or constructing it in-house. So that is also the second basis of measurement, current cost, the amount that we will incur in today's term to acquire that same asset. If that asset was manufactured by us or was constructed by us, then the current cost will be in the context of reproduction cost. But then if that asset was acquired from the outside, was purchased from someone somewhere else, then the current cost will be applied in the context of replacement cost. Does that make sense so far? So if there are any questions, please put it in the chat for me, for those of you on YouTube, and then you put it in the comment section for those of you who are watching us on Facebook as well. So that's the second thing, current cost. The third thing is the net realizable value. Now, that asset that we have, net realizable value simply means that how much the asset can be sold for less the cost to sell the asset. That's the net realizable value, the amount receivable by an entity from the disposal of an asset less the cost of sales. The amount receivable by an entity from the disposal of an asset less any cost of sales. So what does that mean then? It means that the net realizable value is simply going to be the fair value, or if you want the selling price, minus cost to sell. The selling price minus cost to sell. So that is going to be the issue about the net realizable value. Now, what does that mean? So let's say that we have whatever. What should we have? Let's say we have an iPad, okay? And we have an iPad. So we bought an iPad. Let's say we bought the 2020 version of the iPad. So let's say whatever. Let's say we paid $1,000 for that at the end of the day. And so how much we bought it last year is going to be the historical cost. Okay. So last year, in 2020, June 2020, did I say June already? January 2022, if we want to buy that same iPad in today's term, how much are we going to pay? That is going to be the current cost. So how much we paid last year, historical cost, how much we will pay right now is the current cost. Now, if that iPad that we bought a year ago or so, we want to sell it now, how much are we going to sell it for less the cost of sales? That is the net realizable value. So let's say that we can sell the iPad for $800, but for us to sell it, we need to engage an agent, someone who arranges people to buy iPad. And so we will get the agent, we will give the agent a commission of say 10% of the selling price. What it then means is that our net realizable value, the amount that we are going to be receiving from the sales of the laptop, is going to be the 800, which is the selling price of the laptop, minus the 10% that we will give to the agent. That is 10% of 800, that is 80. So technically the amount of money coming to us is going to be $720. That is what we mean by the net realizable value, the amount receivable by an entity from the sale of the asset, less cost to sell, less cost to sell. So that is the issue about that. Okay, I see some comments coming in. Let me bring them up. Favored Sharon Stone said, please come again with explanation for replacement cost. Then Mamba said, kindly explain a bit once more on replacement cost, and kindly explain a bit once more on replacement and reproduction cost. Okay, so what we are saying here is that the current cost has to do with how much we will pay in today's term to get that same asset that probably we had constructed or acquired some years ago. Now, if the asset was manufactured by the entity itself or constructed by the entity itself, if we want to construct that same asset today, we want to build that same asset today, or we want to manufacture that same asset today, how much are we going to incur in the production of that asset? So in that context, the current price, or the current cost will come from the context of reproduction cost. So we are saying that the reproduction cost applies in the context of current cost if the entity manufactured, built, or constructed the asset in question. But then if the entity did not manufacture, because it is only in manufacturing, construction, and building that you would deal with reproduction costs. Are you getting it? It is when you are putting something together that we talk about reproduction. But then if the entity did not manufacture, did not construct, did not build the asset, then what is going to be happening is that the entity will acquire the asset. In that case, where the entity acquires the asset, we say that the current cost, which is how much we will pay to acquire that same asset in today's term, it's going to be in the context of the replacement cost. Does that make sense? Favored Sharon Stone and then Wape Momba. Let me know if that makes sense for you guys, because you raised concern about this. Let me know if there are any other questions. Please, you bring it up as we proceed with our discussion. So you bring it up as we proceed with our discussion. So next one, fair value. Okay, so Sharon Stone said she's okay. Momba, let me know if your point is also addressed for you. So let's go. Next one, fair value. Fair value. So when we say fair value, what does that mean? In a simple language, we say that fair value is simply the value at which an asset can be exchanged or a liability settled in an arm's length transaction between market participants. Okay, that is the idea about fair value. So when we talk about fair value, one, asset, the value at which an asset can be exchanged. Okay, so the value at which an asset can be exchanged. So again, back to my laptop scenario. How much will I get if I sell that laptop, or how much will it is it being sold for now? The value at which it's being sold for now is what refers to as what? The fair value. The fair value. And then when we talk about the fair value of a liability, we mean that the amount at which a liability can be what? Settled. Because when it comes to liability, it's about settlement. We need to pay for it. But when it comes to assets, it's about exchange. We give the asset to the person and then we get income in return for that. That is what we mean by fair value. Please note that fair value may not be the same as selling price. Okay? Fair value may not be the same as the selling price. I'm mixing the words. Fair value may not be the same as selling price. Why is that? The reason is that we determine fair value by looking at the value at which, say, an asset can be exchanged among independent parties. So let's say, for instance, we are selling again my iPad. Then we'll ask if anybody or everyone at all, people who buy the iPad, if they are buying that iPad, how much would they pay for the iPad? Okay, they will pay $800. Then that will be the fair value. But let's say that iPad that everybody is buying, or everybody will buy at $800, I'm selling that iPad to my wife. If I'm selling that iPad to my wife, then I may not sell it to my wife at $800. Probably I'll say that, okay, honey, just give me maybe £300 or $300. So what's going on here? The fair value is 800, but because of the relationship that I have with my wife, I will sell it to her at what? $300. So sometimes, or not always, the selling price will be different from what? The fair value. And the reason why the selling price is always lower than the fair value is because of what we call related party transaction as per IAS 24. Okay. So as per IAS 24, related party transaction, because like I said, my wife, in the context, it's not in the context of business, but we say we are related. Does that make sense? So something that I will sell to people $800, I will sell to my wife $300. That is not a fair value, but because of our relationship, the selling price is going to be lower than the fair value of the asset. That is the difference between selling price and fair value. So get that very well. Let me know if there are any questions about that. So fair value is the value at which an asset can be exchanged or a liability settled. The value at which an asset can be exchanged or a liability settled. Then we come to the final thing, and that is going to be value in use. Okay, so Mamba said, I understand. Then Juliet Kindeke said, hi, Nhyira. Hello, Juliet. I hope you're doing well. Thanks for joining us. Ebenezer Atta said, you will use your own $300 for your wife. Meaning that she won't pay. Eh? Don't worry, I'll let her pay. I'll deduct it from her chop money. Like we say in Ghana, chop money. Like, I mean, this day and age, you still give chop money, that kind of thing. I'll deduct it from her chop money. Okay, so value in use. So what is value in use? What is value in use? What, like the name suggests, value in use. So if the entity decides not to sell the asset, but then the entity decides to continue to use the assets in the business, how much we will get from the continuous usage of the asset? That is what we mean by value in use. Does that make sense? So value in use simply refers to the amount of economic benefits, okay, that an entity expects to generate, expected to be generated from the continuous usage of the assets. From the continuous usage of the assets. So if the entity does not sell the assets, the entity uses the assets, the entity does not dispose of the assets right now, and the entity use the assets for the rest of its remaining life, that is going to be what we refer to as what? The value in use. Now, always know that the value in use will be discounted into present terms. So we're going to be discounting that into present value using the cost of capital of the company. because these are expectations. So it's in the future. So we have to bring those future cash flows into present terms. So if you are bringing those future cash flows into present terms, that means we are getting the value in use. So we're going to be discounting the money into present terms to determine that as well. Now you're going to be using, like I said, something like the net realizable value and then the value in use when you are dealing with IAS 36 impairment of assets. Then you're going to be using historical cost along with these guys again when you're dealing with impairment of assets. So when we talk about the basis of measurement, these are the basis of measurement of elements in the financial statements. Okay, the basis of measurement of elements in the financial statement. So historical cost, how much we paid in the past. Current cost, how much we will pay right now to get the same asset. Net realizable value, how much we will get when we sell an asset and paying for any cost of sales or cost to sell. Fair value, how much the asset could be exchanged for money. And then value in use, how much economic benefit that the entity derives from the continuous usage of the asset, Any questions, please? These are the bases of measurement. I see some of you guys coming up. Give us a thumbs up on the video when you join on YouTube. It helps us a lot to get more engagement. In case you've not subscribed, also you can subscribe to the channel and click the bell notification icon so that when I go live, you will be notified and join the stream. Wise Brain said, great. Okay, Wise Brain. Your name there, Wise Brain. Wow, that's a double decker name though. Okay, so these are the bases of measurement, right? These are the bases of measurement. So now let's expand. Now that we've got the basis of measurements covered, let's go back and deal with IAS 2, accounting for inventories. You good? So let's go. Now, please note that the material that I'm using and I'll be using throughout our discussion is the material coming from my new book on financial reporting and corporate reporting. So we have a new book on financial reporting and corporate reporting that we are having in that case. I'm only hearing the audio but no video. Why? Has my video feed stopped? Has my video feed stopped on everybody else's end? Because Richmond by Baden said, I'm only hearing the audio but no video. Has my audio stopped? Like my video stopped? I don't know, MTN today, they just want to screw me up. Okay, let's see. Miriam said no. Sharon said no. Victoria said it's okay here. Sharon said it's okay. Benjamin on Facebook said no, it's fine here. Oh, okay. So thank you. Richmond, please check your network or your device, because at least my video, my slide that I'm sharing, it's moving there. It's moving there. Paul Awonyo on Facebook said, no, I can hear you loud and clear. Okay, that's awesome. Thank you guys very much. Anita said, no, please, I can hear and see the video. Okay, thank you very much. All right, so let's go. IAS 2, inventories. Now, like I was saying, the document or the slide I'll be using on this discussion is from my book on financial reporting and corporate reporting, and that is what we'll be using. And we're going to be using that throughout our discussion. So questions that we'll be solving all will be coming from this book as well on the live stream in that manner. So let's go. When we say IAS 2, I mean, what is the objective? Simple. When you take the accounting standards, please take note of this. When you take the accounting standards, there are a couple of them that you must take into consideration, a number of things. Number one, you need to know the objective of the standard. Okay, what is the objective of the standard? You must know the objective of the standard, or what sometimes is referred to as the overview of the standard. So whether you like it or not, whatever standard you pick, the first thing you must ask yourself is, what is the objective of this standard? What is the overview of the standard? In other words, what is this standard? What purpose is this standard serving in the scope of financial statement preparation? Number two, you must understand some key definitions that are relevant to the standard. Now, not all the standards have a lot of definitions. Some of them have only one or two definitions that you need to understand, but the objective, the key definitions. Number three, because the standards looks at elements in the financial statement, the third thing you want to be careful about is the recognition criteria. So the objective of the standard, the key definitions, the recognition criteria, that is going to be very critical at the end of the day. Number four, setting standards like IAS 40, IAS 38, we will have to deal with what is called initial measurement. And then number five, subsequent measurement. Initial measurement and then subsequent measurement. So with these two issues, you will deal with them at most when you're dealing with standards like IAS 40, IAS 16, IAS 38. Okay, intangible asset. If you're dealing with these standards, you deal with initial measurement, subsequent measurement, IFRS 16 leases. You deal with this as well. In that particular case, IFRS 5, IFRS 9. Sorry, you're going to be dealing with this as well. So there are certain standards that will require you to do initial measurement of the elements or the transactions, the transaction in the question, then also the subsequent measurement. IAS 37 is also going to be requiring us doing initial measurement and subsequent measurement. Then you come to number 6, another critical issue that will be the disclosure requirements for the standard. The disclosure requirement for the standard. So when you pick the standards up, you must know what is the objective of the standard. What is it about? What is it looking at? What is the overview? What are key definitions that we need to pay attention to? Number 3, what is the recognition criteria for the item? For instance, when it comes to provision, we say if it is rotten, you provide for it. If we come to IFRS 5, there is a recognition criteria for it. Then we need to determine the initial measurement of an asset, a property, plant, and equipment, or an investment property or an intangible asset as per the standard. So we must know the initial measurement, the subsequent measurement, and we must also know about the disclosure requirements. So when you pick the standards, you make sure that you understand these things. Why is this important? Because from the recognition criteria up to the disclosure requirements, that is where the examiner can bring a question from. So the examiner can ask you to explain the recognition criteria for a standard, let's say IFRS 5. How do we recognize revenue under IFRS 15? Sorry, revenue from contract with customers. What is the recognition criteria? There are 5 stages or the 5 steps that must be followed in order to recognize revenue under this particular standard. So we must know about that very well. So when you get to each of the standards, you have to ask yourself, what is the recognition criteria? You have to ask yourself, how is the initial measurement done? You have to ask yourself, after the initial measurement, how do we subsequently account for the item, for the elements in the financial statement? Then what are the disclosure requirements we need to know about the standards in our note? That is very critical for you to understand. Okay? That's very critical. Now, so this is why when you are learning the standards, you need to keep whatever, a notes by yourself to be able to look at it in that particular case. Now, I see some questions coming in. Let me see if I can take them. Mamba said, it's okay here too in Zambia. All right. Richmond said, I refresh and I'm having the view now. Thank you. All right. No. Why is brain? Okay. John Malongo said, how are you doing, sir? I'm flourishing, John. I hope you're doing well. Thank you for your nice presentation. Always a pleasure. Frank Timer said, when computing value in use, how are future cash flows determined? Usually the future cash flows are determined based on the expected economic benefits from the assets. Okay, so the entity would decide based on, they could use best estimates, or they could use historical information, or they could use a similar asset and that they had used in the past and how much they generate from the assets. So the determination of the future cash flows will be at the discretion of the professional judgment of the entity, at the discretion of the professional judgment of the entity. So the entity can use its own internal data based on past information, or the entity can say, okay, when we use the asset for the next 3 years, for the next 4 years, we expect to have this amount of money over the next 4 years, and that will guide the company to set the amount that they must use. So let's come back to the inventory. So you realize that before we get into the standard itself, I don't know if you are getting the picture. You realize that before we go to the standard itself, we must understand the basis of measurement. So because when you start with the standard and they use the terminology fair value, or they use the terminology historical cost, then you'll be asking yourself, what the heck is this thing? So then you have to go back and then get that. So that is why I went back to talk about this and also explain to you the things we need to understand. So let's go. IAS2 objective. So what is the objective of IAS2? It's very simple. The objective of IAS2 is to prescribe the accounting treatment for inventories. That's all. That's all. The accounting treatment for inventories. But then the big question we then ask ourselves is, what is inventories? When we say inventories, what are we talking about? So the standard defines what inventories are that we must take note of. So inventories include assets held for sale in the ordinary course of business, that is finished goods, assets in the production process for sale in the ordinary course of business, that is work in progress, and materials and supplies that are consumed in production, that is raw materials. So it means that there are examples of inventories. Anything that we would be selling at the end of the day as an entity will be considered as what? An inventory. It is for this reason why later on you will see when we get to IFRS 16, IFRS 5, non-current asset held for sale and discontinued operation, on subsequent measurement, it is accounted for just like how inventories are what? Accounted for. Because now, even though it is an asset, the entity has decided to sell it just like how it will sell any ordinary business or any ordinary asset that it has as inventories. So that is the thing we need to understand. The objective of this standard is to prescribe the accounting treatment for inventories. What are inventories? Inventories that are assets that are held for resale. And so it could be raw materials, it could be work in progress, or it could be what? Finished goods. Finished goods. So, box check. We've looked at the objective of the standard. We've looked at a key definition, which is what inventories are. Okay, we've looked at that, which is what inventories are, and that is what we are interested in when it comes to dealing with this particular standard. But the question we ask ourselves is, what is the fundamental principle? I think I said this in my introduction. This is the fundamental principle you have to take away. At the end of the day, everything that I'm going to say, if you don't get anything out of it, this fundamental principle is what you must get. What does that mean? It means that inventory should be carried at lower of cost and net realizable value, period. So the way we're going to be, once the item is an inventory, we're going to compare two things. We will compare two things and take the lower, the cost of the inventory, and then the net realizable value. Once we compare the two, the one that is lower becomes the value that we will place on the asset. But how do we measure assets? So initial measurement. Initial measurement. The standard states that the initial cost of an inventory shall be the cost of purchases, including any taxes, transport, handling, net of any trade discounts received. You know, when you buy inventories in bulk, you are likely to receive some trade discount or what is called quantity discount. If it happens that we receive anything like trade discounts or quantity discounts, it is going to be subtracted from the purchases cost of the inventory. But then if there are any taxes we need to pay, import duties, there are any delivery costs, that is cost, oh, there's a name for it. Carriage inwards. Yeah, we call it carriage inwards. How much you pay to carry your goods into your business, and then handling cost. All these will be included in arriving at what the purchases cost. There are times when the inventory is not bought from outside, so the company manufactures the inventory in-house. In that case, then we say that the cost of the inventory will be the cost of what? The conversion. That is going to be including both fixed and variable manufacturing overhead. So if we manufacture the inventory in-house, then the raw material cost will come in, then all other production overheads that we will incur will also be coming in that particular case. Then any other cost we incur in bringing the inventories to their present location or present use. Any other cost we incur in bringing the inventories to their present location or their present use will be something that we have to consider. That is what we mean by the initial cost of inventories. So, what does that mean? In a nutshell, this is the takeaway I want you to have when it comes to dealing with the initial measurement of inventories. So, we say that the initial cost of inventory, so the initial cost of inventories shall be the purchases cost, or manufacturing cost, and other directly attributable costs, incurred in bringing inventories to their present condition or use. So all the costs we incurred, whether purchases cost if we bought it from outside, manufacturing cost if we produced it in-house, and all other directly attributable costs will be incurred. Now, the directly attributable costs they include things like the transport we spoke about, the handling costs we spoke about, the taxes that we spoke about relating to the purchases. All those will be included in arriving at the initial cost. Now, so once the inventory is bought, double entry, we're going to be debiting inventory because that's an asset. It's an inventory and it's a current asset. Then we'll credit cash if we paid cash, or bank if we are supposed to make bank payments, or payables if it is outstanding. Because sometimes we may buy the goods on credit. If we bought the goods on credit, then trade payables will be credited in that context. If we bought the goods on credit, then trade payable will be credited in that context. So that is the journal entry for the initial recognition. Initial recognition. But after the initial recognition, what do? We come to the subsequent measurement, and that is where the fundamental principle shine. The subsequent measurement. The subsequent measurement. So, like we said a moment ago, with subsequent measurement, I see some of you guys joining. If there are any questions, please put it in the chat. For those of you on YouTube, put it in the comment section. For those of you on Facebook, and also give us a thumbs up on the video when you join. It helps us a lot so we can reach as many students as possible watching the live stream and joining us on the live stream. So, how do we, what constitutes the cost? And what is the net realizable value? Now, you know these already, so we're just going to be expanding on them a little bit. So stay with me carefully. So like we said already, the cost of inventory is the cost incurred in bringing inventory to its present condition or location. So that will be material cost, labor cost, manufacturing overhead. When we add these three up, that gives us the cost of the inventories. Then we come to the net realizable value. The net realizable value. Like we said, the net realizable value is going to be an issue in relation to the selling price less the cost to sell. Now you realize that there are two components of cost to sell here. There are two components of cost to sell here. We have the cost to complete and then the cost of selling. Now, sometimes the cost of to complete comes in because maybe the inventories are damaged and then we need to repair the inventories. We need to restore the inventories to a certain level before it can be sold. So if the inventories are damaged and we can do something about it before we sell, then that becomes an element that we have to deduct from the selling price in arriving at the net realizable value. So these are the two things that you must understand in that case when it comes to those issues. But the big question is, once we carry this out, how do we account for it? If your cost is greater than your net realizable value, we say that the inventory has suffered impairment. So we say inventories have suffered impairment. So we say the inventories have suffered impairment. Okay? If your cost, how much you are carrying it out in your books, is greater than the net realizable value, how much you will get if you sell that asset today, that becomes it means the asset has suffered what? An impairment. Now, if it has suffered an impairment, what is the double entry? Impairment is supposed to be written off directly in the P&L. So any written down of inventories will be taken to the P&L. So we debit profit or loss with the impairment value and definitely credit inventories. Definitely credit inventories. So that is the issue about the written down or the loss in value of inventories when we compare the two. Now, if the cost of the inventory is less than the net realizable value, you do nothing. So the inventory will still be carried at the cost. Okay? The inventory is still carried at cost. The inventory is still carried at cost. So that is something you need to understand. When your cost is greater than the net realizable value, there is an impairment, and that impairment must be written down. Hence, you debit profit or loss credit inventories. But if you do the comparison and you realize that the cost of the inventory is less than the net realizable value, you do nothing. All you do is the inventory is still going to be carried at what? Its cost. Why? Because we said inventory should be carried at lower of cost and net realizable value. That is the issue you must understand in that particular case. Any questions for me so far? Any questions for me so far? Any questions for me so far? What it means is that inventory cannot be carried over its cost. Do you understand it? We cannot carry inventory over its cost. Are you getting the idea? The cost is the minimum that we can carry it at the end of the day. For that reason, there is nothing like revaluation surplus and revaluation gain when you're dealing with inventories. We don't revalue inventories. All we do is what is the net realizable value, what is the cost. Then we compare the two, and the results determines what we do as an organization. Any questions, please? Any questions, please? Let's see. John Malongo said, Tanzania is missing you. Okay, that's awesome. Thanks, Tanzania. Peter said, all is well. Okay. Johnson Alacrua said, forgive me if I don't mention your name right, okay? What is the online lecture so that I can follow up from time to time? Thanks, sir. If you are referring to our live stream on YouTube, you can follow me on Instagram. We will come live 4:30 p.m. during the weekdays. So you follow me on Instagram. The details are posted on my Instagram page, so you know what you have to do. The handle is the same as the name on the channel here. But if you are referring to our paid program, that one is 390 Ghana cedis per paper, and that has a different timetable for our regular classes online via Zoom. And you can check the first description of this first link in the video description to get that coming in. Joseph Mumbi said, good presentation. Thank you, Joseph. Johnson said, when is your online lecture? Okay, I think that's the repetition from Nigeria. Okay, Joseph, thanks for joining us. Give us a thumbs up on the video. Mumba said, what does impairment mean? Okay. You will look at this on the IAS 36 though, but impairment is simply the fall in value of an asset. In other words, this is what it means. When the net realizable value of an asset is less than the cost of the asset, or the cost of the asset is greater than the net realizable value of the asset, we say the asset has suffered impairment. Okay, because you bought it, your cost, it's say $1,800. But then now you can, when you sell that same inventory that you bought at 1,008, and you pay a commissioner or a sales personnel his or her commission, you are getting only 1,250. So meaning that you cannot still carry the inventory at 1,008, because nobody will give you 1,008 for that inventory. Instead, what they will give you is 1,250. So the difference between the two is a reduction in the inventory that you have in your possession, and that reduction in the inventory you have in your possession due to the selling value of that inventory is what we refer to as impairment of assets. Impairment of assets. Does that make sense, Mumba? Then he says, if a company transfers its of the business segment, will it be, I don't know, Aham Bag, please retype because it's like something is missing there. If a business transfers its what of business segment, maybe give me that very well. Will it be discontinued operation? I mean, the business is transferred to another group entity. It is transferred to another group entity. Okay, if a company transfer one of its business segments to another member in the group, no, it's in the same group. So from the perspective of consolidated financial statement, it is still going to be accounted for as a business on its own. It cannot be recognized as non-current asset held for sale. We will be looking at that later on. Mamba said, thanks, sorry, very much. Okay. So Aham Bade, you stay tuned. We'll be looking at IFRS 5. When we look at IFRS 5, these things will be answered. When you transfer an asset, you only deal with it under IFRS 5 if you want to sell it. So as far as the group is not selling, and we are just transferring it from one entity to another entity, on the consolidated financial statement, the asset is not sold. But then in their individual books, the one doing the transfer will treat it as, yes, a held for sale, meaning if the transfer is done, meaning they've sold it. So it's not even held for sale. It's just disposal of assets in their books. Then the one who bought the asset, the other entity who bought the asset, will be looking at it as a purchases of assets in that case. But on the consolidated level, nothing has happened. The asset will still be accounted for as the asset of the entity. So that's the issue there. Let me know if there are any other questions for me. Okay. So now that we have this understanding, let's crunch some numbers. Now, before then, the following costs shall not be included in the cost of an inventory. So if you have inventories and you are determining the cost of an inventory, the following cannot be included in the cost of an inventory. Number one, abnormal waste. This is when you are producing the thing. So if you are producing the thing, Normal waste can be included, but abnormal waste cannot be included. Storage cost. Now, storage cost is an expenses that must be written off. It is not something that relates to the manufacturing or bringing the asset to its present use. Now, some of these things are debatable sometimes, though. Administrative overheads that are not related to production. So, if the entity incurs any administrative overheads that's not related to production, then it's going to be coming here. Now, one thing I didn't mention about the initial cost when we're talking about it is that borrowing cost may be included in determining the initial cost of an inventory. So that is IAS 23. So you realize that here there is going to be IAS 23 that may react that we need to look out for. Borrowing costs, and we'll explain borrowing costs later on, and I'll refer you back to IAS 2. So if the company is manufacturing an inventory or the company is constructing an inventory or something like that, something they are producing so they can resell, and the company borrows money to finance that manufacturing of the thing that they are doing to sell, then the cost they are incurring, the interest expenses they are incurring, must be capitalized, must be included for the period from when the production of the thing started to when the inventory becomes ready for its sale. So IAS 23 has a relationship with IAS 2 when we borrow funds to finance the manufacturing or construction of an inventory. I hope that makes sense. So a real estate company, their inventory will be what? Buildings. So if the company goes for a loan to build, then the interest expenses on the loan relating to the time from the construction and the time that the building becomes ready for sale, those interest expenses will be included in the initial cost of the building. And we'll explain this one much further when we are looking at IAS 23. I just want you to know the link between IAS 23 and IAS 2 if we borrow money to manufacture or construct an inventory. Then selling costs. Okay, the selling cost is not included in an inventory. We don't include that. Foreign exchange foreign exchange differences arising directly on the recent acquisition of inventory invoice in foreign currency, it is not taken into consideration because, I mean, we've already acquired the inventory. So if there is any foreign exchange, that would deal with payment aspect, not the asset aspect. Again, IAS 2 has a relationship also with IAS 21, effects of changes in exchange rates. So again, that there is when you are dealing with IAS 21, effect of changes in exchange rate, the way you determine the initial cost of inventories when there is exchange rates and subsequent measurement will be different. And when you get to IAS 21, that will be explained. So you see the connection. There is an IFRS 5 connection that we need to understand. There is an IAS 21 connection. Then there is an IAS 23 connection that we need to understand. All these standards have some relationship with the inventories. You must know where they actually meet in order to understand the idea or understand the total thing in that case. So these are some of the things that we need to understand. Then there are some disclosure requirements that we need to make when it comes to inventories in the financial statement. The accounting policies we are adopting definitely lower of cost and net realizable value. If it is at cost, why are you doing that? If you apply the lower of cost or net realizable value, also why are you doing that? So that is it about IAS 2. Let's look at a question here. A very simple question here about IAS 2. Stay with me carefully as we solve this question. If there are any questions, please bring it up before I go into my question. I don't know if my video is still delaying. Yeah, it appears my video is still freezing. I don't know what's wrong with MTN today, but hopefully the audio and the presentation is going through, so I can manage that a little bit. Okay. Are there any questions? If you have any questions, you put it in the chat. Let me take. Then we'll look at the question on IAS 2 real quick. Now, you can download our mobile application on the App Store, Nhyira Premium, the same name you see on the channel. You download the mobile application, or you go to the Google Play Store for the Android users to be able to download that their app as well. Now, in the application, you'll be able to get access to some exclusive lecture videos. You'll be able to get access to blog posts covering specific topics and specific issues, as well as some practical blogs that will help you as well. Then also you'll be able to enroll in our full course, so you can study directly under my mentorship for the ICA April 2022 examination. So all these and more are available in the mobile application, so you make sure you download it. Remember that our lectures for the April 2022 examination is also ongoing. So in case you have not registered, you can register to study directly under my mentorship, get access to our ebooks, our question kits, join our live Zoom sessions, join our executive revision masterclass, get access to our examination analysis documents, so you can prepare well for the examination. And all these is going for 390 Ghana cedis per paper. And so you can check the description. The first link there will take you to our website, and you'll be able to enroll in the course to study under my mentorship. So let's go straight up back and let's solve the question that we have. Let's solve the question that we have. So let's see. What's the requirement here? It says, what figure for closing inventory would be in the statement of financial position? What figure for closing inventory will be in the statement of financial position? What figure of closing inventory will be in the statement of financial position? So let's look at it there. So Neil Neil paid $3 per unit for raw materials of its products. $3 per unit for raw materials for its products. So they pay $3. To complete each unit, it incurred $2 per unit direct labor. Production overheads for the year based on normal production of 120,000 units was $72,000. Due to industrial action, 10,000 units were produced, 1,000 units were in inventory at the end of the year. Now, stay with me carefully. If you're reading the question, you need to make sure you read it and understand it very well in order for you to really be able to look at what is going on. So if you look at this question here, we are told that what figure for closing inventory? So the question you ask yourself is, what is the closing inventory? We are told that even though the company produced 10,000, only 1,000 is left. So if we go to the books of Neil, if we go into their books, the inventory being valued are 1,000 units. So that's the closing inventory that we are placing a value on, right? Let's go back. Then he says it is estimated that 200 units will now only be sold for $12 each after a repair of $2 each. Now, stay with me carefully and understand what is going on. So there are 1,000 inventories, but this 1,000, there are two things that are happening here. The 1,800 is undamaged, okay, not destroyed. Nothing is wrong with it. But then the 200 is damaged. Okay, if it is damaged, then we need to repair the damage. And we are told that to repair the damage for this 200, we incur $2 per unit. The question then is, how can we value this particular inventory going on here? Now, you realize that for the 200 units, because it has an element of cost of repair, we will value the 200 units at its net realizable value. Then the 800 units is going to be valued at the manufacturing cost. So let's break it down and let's actually find out what exactly we can do here. So if we go back to the question, we need to get a factory cost. That is the cost the company incurs to produce the inventory. So if we want the factory cost, slash in our currency sign, it includes raw material cost, and that is $3. So raw material cost, $3. Then we will have direct labor, $2. That is going to come up. Direct labor of $2 will come up. Now, when we add the two, it gives us $5, and that is prime cost. The management accounting students will understand this. Then there is also a manufacturing overhead in the question. We are told that the production overhead for the year is based on an output of 12,000 units. It's $72,000. So the question is, we need to get a production overhead per unit. So we add factory overheads. So because we are working on per unit basis, that's going to be the 72,000 over the 12,000. Okay, the 72 over 12. Let's punch that out and let's see the answer we are getting. 72,000 divided by 12,000. I'm getting $6. Getting $6. So we add it up, and that's $11, and that gives us the factory cost. So for this inventory that the company is manufacturing, the factory cost is expected to be $11. $11. Then the question we ask ourselves is, what is the net realizable value? The net realizable value. Oh, so the net realizable value. So if we look at the net realizable value, we say the net realizable value is the selling cost. If we go back to the question, we are told that the 200 inventories. Remember, the examiner is giving you information about the 200, not all the inventories, but just the 200. So the 200 inventory can now be sold for $12 per unit. So our selling price is 12. It's $12. But then the examiner said after they made a repair of what? 2. So repair cost 2. So we less that. Once we less that, that gives us our net realizable value, and that's 10. That's 10. So you realize that for the 800 units, the examiner didn't give us selling price for the 800. So now, once we have this, we will say the value of the closing stock, the value of the closing inventory will be as follows. The undamaged inventories, the 800, will be 800 at the manufacturing cost, which is 11. Now, why are we using the manufacturing cost? Because that 800 units, the examiner didn't give us the selling price of it. In this question, the selling price was given in relation to the damaged inventories. So 800 by 11, that's 8,800. Sounds good? Then we come to the damaged inventories. So with the damaged inventory, that is the 200 units by the cost, which is low, the net realizable value, which is lower. You know, we compare the two. If you realize it, the two, 11 and 10, which is smaller, it is the net realizable value. So the 200 will be valued at the net realizable value of 10. So that's 2,000. So that the inventory cost in the statement of financial position will become 10,800. Any questions, please? That is the answer to the question that we have here. That is the answer to the question that we have here. That's the question, answer to the question we have here. So any questions, please? Any questions for me? Any questions for me? Isaac Gogo, Sickle A. Williams, and Eric Autry, thanks for the thumbs up on Facebook. We really appreciate it. It helps us a lot. And for those of you on YouTube also, thanks for the thumbs up on the video. So that is the answer to this question. So what are we saying? The takeaway here is that when it comes to the inventories, it is going to be accounted for at lower of cost and net realizable value. Stone said, please, the calculation for factory overhead, explain it again. We are told in the question that production overheads for the year based on normal output of 12,000 units was 72,000. When it comes to accounting for overhead, we absorb it. Okay, when you do management accounting, you understand this better. But the idea simply is that we absorb it in that particular case. We absorb it in that case. Then, so the question then is, when it comes to the production overheads, how do we calculate that? We calculate that by looking at the issue in relation to the total overhead, which is the 72,000. Okay, the total overhead, which is the 72,000. Then we divide it by the 12,000 units. That's how we get the production overheads. So the overheads, all the overheads is 72,000, but it is 72,000 because the entity expects to produce 12,000 units. The factory cost we are calculating is factory cost per unit. Hence, we divide the 72,000, which is the total overhead, by the 12,000 in that particular case. So that is it about it. Sharon Stone. Benjamin Tavia said, please, what happens to the 10,000 produced as a result of industrial action? Nothing happens to it. We are not supposed, we are supposed, the requirement is what figure of closing inventory. Our focus is valuation of inventories, not the unit that has been produced by the company. The 10,000 is what has been produced by the company, but we are not interested in that. So we're not going to use it for anything in our calculation, because in financial reporting, we are interested in, or and IAS too, we are interested in the valuation of the closing inventory. So we don't do anything to the 10,000 because we are not going to need it for anything. Sharon said, okay. Thank you. Okay. You are welcome. Does that make sense for you? Let me know. Any other questions? All right. So Benjamin said, all right, sir. Okay. That's fine. Okay. Okay, so that is it basically about IAS2 generally. If you need to understand some things, that is it basically about IAS2. These are the key issues that we need to understand. Now, there are some other issues about the way we account for inventories, whether we use the FIFO method or the LIFO method. That is also there, but I'm not going to be covering that for the purpose of the way we want to present our issues. Those things, if you do management accounting, you will understand how to use prepare the stock sheet or the store ledger card using FIFO, simple average and weighted average and all those things. So at this level or in these things, we are just focusing on how do we value the inventory initially, how do we determine do the subsequent measurement, and then how do we value it at the end of the year. So that is basically what we must understand when we talk about IAS 2 inventories. IAS 2 inventories. Any questions for me, please? Any questions for me, please? Remember, like I said, if you missed yesterday's lecture, you can check the description of this video. The link is going to be available there, and you can watch yesterday's lecture if you missed it, because I explained how to connect the standards with each other, and that is going to really help you in that case. Now, because of time constraints, I'm going to conclude here today. God willing, tomorrow I'm going to be coming your way, same time, 12:30 p.m. And then we'll look at the IFRS 5, non-current asset held for sale, and you will see how the inventory rule that we learned here, that inventory should be carried at lower of cost and net realizable value, will apply when we are dealing with IFRS 2 as well in that case. So that is it about that. Thank you very much for joining, and sorry for the my video, like my main video feed, what is on me, pausing. I don't know. It's then the network is messing me up. I don't know what's going on, or maybe my streaming software is the one that is messing me up. I don't know, but I hope that we were able to have a good time. So thanks very much for joining me on the live stream. I'll catch you same time tomorrow. Remember to subscribe to the channel if you have not subscribed to the channel, and follow me on Instagram if you're on Instagram at Nhyira Premium, the same name on the channel here. That way you will be able to know what we'll be discussing and various other things that you must understand in that regard. So that's it about that. And let's see. Sharon said, yes, please. Thanks for your time. God bless you. God bless you too for joining us. Thanks for your wonderful presentation. Always a pleasure, Sharon. Abdul said, thanks for your time. God bless you. God bless you too. Thank you very much for joining us. And thanks you guys for the thumbs up. For those of you who share the video, God bless you. Really appreciate it from the bottom of my heart, because that is how we're able to reach a lot of students and assist a lot of students who are preparing for the examination. So I'll catch you same time tomorrow at 4:30 p.m. GMT as we continue with our discussion towards the ICA April 2022 examination. Remember to keep studying and keep working hard, because we have about 9 more weeks to go for the exams. And my wish and desire is for you to be prepared for the exams and pass the exams. I'll catch you same time tomorrow. Bye-bye.